First of all, okay. First of all, wherever you are, thank you very much for joining this webinar. I'm in Calgary, Canada right now. It's 9:30 in the morning. It's a beautiful week in Calgary. We have 25-degree weather, so that's something to relish in Canada. So wherever you are, whichever part of the world, whether it's good morning, good evening, or good afternoon for you, thank you very much for attending this webinar. I'm really excited about doing this. I would like to thank Nikhil Agarwal and Petroleum Engineers Association for, first of all, inviting me to conduct this webinar through their platform. And also, as he mentioned, we may be doing a full-length course also on the same topic later in fall, which will go into a lot more detail. I have developed this webinar and this course over the years, and it's really a summary of whatever I've learned in the oil oil and gas industry in the last 30 years, working around the world. Some of the best practices that I've seen, some of the things that I've observed and learned over the years, and I've kind of blended that with a little bit of theory, and so it's really a very practical webinar and a very practical course. There's hardly any equations in the course at all or in the webinar, so it's all very practical and quite simple. Also, I like to keep it. I like to keep it on the ground. I like to keep it as simple as possible so that people can follow and hopefully learn something from it. Um, the format, I mean, I've got about 20 odd slides, so I'll try to speak for about 35-40 minutes, and I do want to keep plenty of time at the end, about 15-20 minutes for any questions or discussions that you may have. My voice is a little bit hoarse because I caught a cold yesterday because the flu season going on in Calgary also. Anyway, so with that, let's get started. What are we going to look at today? So we will look at integrated field development planning. We'll have a little bit of discussion on what that actually means. We will look at the different stages of field development. I've got a couple of slides on resource in place estimation. Really, what we're trying to determine is how big is the tank. This is one of the key tasks in oil and gas industry. It really everything starts from here. Everything keys off from here in field development. We will look at fluid characterization and reservoir management in just a few slides. And then right at the end, I want to bring it all together in economic evaluation and decision analysis. And really, this is quantifying the economic value of your development plan. In the end, we are in the business of making money. We are not in the business of, producing more oil and gas. Yeah, that's nice also, but it has to make money. If it's not making money, then no company is going to approve a project just because of science or just because of that it looks good. There could be other strategic reasons, but in the end, we are in the business of making money, and that's where this is the most important. If you have any questions or comments, please note them down and think about it. As like I said, in the end, we will have time to go through them. So what is integrated field development planning? Oil and gas field development is a complex task. It involves various uncertainties and unknowns. And these uncertainties in oil and gas field development are related to the entire spectrum of our business, all the way from subsurface to commercial considerations and everything in between, like surface processing facilities and production operations and everything. Everything has uncertainty and unknowns. Integrated field development planning requires the coming together of the various disciplines to address and quantify these uncertainties. In oil and gas field development, we have a tendency to focus just on our discipline. I'm equally guilty of that. I'm subsurface, I'm a reservoir engineer. I think that whatever I do is the most important and I don't need to consider other factors that go into field development planning. Well, that's not correct. Every discipline has their own uncertainties and has their own variables that they must address, and we all need to work together so that everybody's needs and requirements are met and constraints are kept in view while developing a field development plan. Data acquisition, knowledge sharing, and the smooth flow of information across the various disciplines is critical for an efficient and quote unquote good field development plan that is the most economically beneficial. If production operations need something, we need to make sure that they have that data. If subsurface requires something, we need to make sure that we are acquiring that data and that's being relayed across the organization. Similarly, commercial, they need certain information to be able to be able to do their work. So all of that needs to come together in an organization instead of working in silos. If there's any miscommunication or if knowledge is not going across the organization, you're in for some surprises later on, which you would have thought you should have solved earlier rather than later, and then it can be a really costly mistake and costly solution to overcome that. It's important to note that management relies on the technical staff to keep them informed about the various issues in field development. They're trying to negotiate with the various other stakeholders in field development. These could be regulatory authorities like government functions, financial markets, joint venture partners, and then the internal corporate management and board. So as they try to negotiate the best deal for the company, they have to be aware of what are some of the issues and challenges in field development, and what are we doing to address them and to solve them. I want to spend a little bit of time on this slide. This is different stages of field development. So a typical oil and gas field moves from prospect to discovery to appraisal to development and then onwards to production. And then a couple of milestones that I would like to focus on. So right at the end of the appraisal, so the appraisal is the stage where we're trying to determine how big the field is, how much oil and gas does it have, what sort of recovery factors, what sort of production rates can we expect to obtain from this oil and gas field, and what sort of surface processing facilities or capital investment may be required. And once we can convince ourselves that we have a commercial solution, that's where not only your company, but all the stakeholders involved, that is the government and other partners, will approve the field development plan, or what's called the final investment decision. And once that is made, then the field can move on to development, where you're drilling more wells and installing the surface processing facilities to be able to obtain the first oil and gas. At the bottom of this slide, you can see the level of capital investment that you can expect in an oil and gas field development as you move from prospect to production. So when you're in prospect, you may or may not even have a well. You may have some surface geological studies, you may have a seismic survey, or you might be acquiring a seismic survey. So your level of capital investment is relatively low. However, as you move into appraisal and development, that's where you have the max capital investment, because now you're drilling wells, you're acquiring more data, you're acquiring more seismic potentially, you're putting in surface processing facilities, there's pipelines, separators, gathering stations, whatever is required to be able to produce this oil and gas, and your capital investment will be the highest. Similarly, your data availability will be the lowest in prospect stage. As I mentioned, you may not even have a well while you're in prospect stage. And as you move forward, you're drilling wells, acquiring more data, pressure data, fluids data, geological data, surface data, commercial data. Your data availability and the level of data availability increases, and the level of uncertainty reduces as the field moves into production. These are some of the decisions involved in field development planning. I've broken them down into 6 categories: from reservoir and fluid characterization, resource in place, hydrocarbon recovery, development strategy, production facilities, and then economics and commercial. And I've highlighted the key uncertainties and the key decisions required in field development planning in the dark green boxes. So under resource in place, volumes of oil and gas in the reservoir, this is one of the key uncertainties that really is the first one that we should be addressing. What is the size of the prize? What is the size of the tank? This is the first question that management or an investor or anybody will ask you if you want to basically explore or develop an oil and gas field. Tell me, how big is the tank? What have you got? What are we looking at? How many billions of barrels? How many trillions of cubic feet of gas? What are we looking at before I can even consider making an investment in this field development plan? Recovery factor, how much do we expect to recover from this oil and gas field? Development strategy, how many wells will be required? Are we looking at any injectors, oil or gas injection? Production facilities, surface processing facilities, what sort of surface processing facilities is required? Because that is a huge capital investment. So we need to know, do we need to process gas? Do we need to process water? How much water do we need to process? How much oil are we looking at to produce? What is the quality of the oil? Um, what sort of surface processing facilities will I need? Do I need compression or not? All these questions need to be answered or have an idea about as you go through your field development planning. And like I said, in the end, we need to bring it all together. What are the economic indicators of this field development plan? Nobody is going to approve a project, even government authorities, without knowing what sort of economics are they looking at. And when we talk about economics, we're talking about net present values, rate of returns. What is the financial value of this project that you are proposing? As part of the week-long full-length course, we will go into each one of them in more detail and have a more detailed discussion regarding some of these uncertainties in different scenarios of oil and gas field development. I've just tried to summarize some of the roles of the various disciplines in oil and gas field development. Again, I've broken them down from geoscientist to reservoir engineer, production engineer, facilities engineer, reserves analyst, and finally economist. And again, I've highlighted the key decisions and key tasks that each of these disciplines are working on. So, for example, geoscientist, resource in place is probably one of the biggest jobs that geoscientists do. They're acquiring all this data, geophysical, geological, logs, scores, in the end to be able to answer the question, what's the resource in place? What is the size of the prize? Reservoir engineers, they're working on resource in place and production forecasting. What are the oil and gas and water rates that we can expect to produce this field at? And what sort of recovery factors can we expect? Production engineers, they're working on production facilities design, wellbore design, what equipment is required. Facilities engineer, they're working on surface facilities design. Reserves analyst, they're looking at what is the level of resource that you can book and categorize for this particular development, because in the end, book value has financial value for the company. And then finally, the economists are looking at the economic evaluation and decision analysis. Again, in the week-long course, we are going to go into more detail into some of these critical tasks and functions that are required in field development planning. I want to spend a couple of slides on resource in place estimation because it's such a critical task. How big is the tank? This is a significant task that is required in field development planning because your level of capital investment, your development strategy is really based upon it. As I said, this is really one of the key questions that anyone, management, investor will ask you. What is the size of the prize? What am I looking at? Is it even worth my time to be considering this oil and gas field development? As I mentioned, geoscientists and reservoir engineers, they're responsible for resource in place assessment. However, they must work together with each other in collaboration to perform this task. If they don't talk to each other, I've seen examples in companies where geoscientists and reservoir engineers are really not collaborating. You're in for a surprise and you're in for some costly mistakes that you should not be doing if there's no collaboration across the company. Various other functions such as drilling, production operations, they are also critical to this because they help in acquiring the data that is required for resource in place estimation. Some of this data is well logs, seismic surveys, production tests, scores, all of that goes into resource in place estimation. And this really is determining about the size of the prize. This way, planning can be carried out on the various resources involved in field development, such as human, material, and financial. So, for example, if you're exploring for offshore West Africa, well, what is the size of the prize? Even at prospect stage, you need to know that. You may have a big range, but you do need to have an idea. What am I looking at? Are we talking about millions of barrels or billions of barrels? So that I can get an idea of whether this is even going to fly. If you're talking about Middle East unconventional, okay, well, what is the size of the prize? What are we trying to chase? Is it even worth my time to be considering this? Because I have an idea of the level of capital investment that might be required for such a project. So are we even is it even worth my time to consider that? So this kind of gives you a quick earlier idea of what you're dealing with. So there are mainly two methods for resource assessment, volumetric and material balance. The volumetric is based on geological and geophysical data, or what's called the petrophysical properties of a reservoir, such as thickness, porosity, and water saturation. Although it's a really simple technique, it's really key because it's applicable all the way from prospect generation to discovery to appraisal, development, and even early production life. In fact, I would say that the volumetric method never goes away. It's always applicable during field development. The material balance is based on more engineering data, so reservoir data, pressure data, and production data. Because it requires production data, you cannot really apply it until the field is on production. And only when it's on production, then its application begins. And even then, it has to have certain favorable conditions for it to be applicable. So really, I like to say that volumetric is king because it's always applicable. It's just that we need to know how to perform the technique and what are some of the key uncertainties that you need to address in applying the volumetric method. Um, as part of the course, we are going to go into both these techniques in a lot more detail and look at real field examples. I really like this slide because this puts the integrated resource assessment workflow in like one summarized slide. So the geoscientists make what is called the aerial extent or the net pay map. Then they will generate a porosity map. Then they will generate a water saturation map of your oil or gas field or prospect. The reservoir engineers need to generate a pressure map, a temperature map, and what's called the formation volume factor. That's whether B sub O or B sub G for oil and gas. And then we apply the volumetric methodology to obtain the oil in place or the gas in place map. So that's your resource in place, that's your size of the prize that you're chasing or you're trying to develop. Let's move on to the next topic, reservoir characterization and fluid characterization and reservoir management. So hydrocarbon fluid characterization is the determination and understanding of the type of reservoir and its associated fluid properties. This is really the first step towards field development planning. So what is your size of the prize and what fluid do you have? What are we dealing with? Considerable resource, that's time, money, and human, is spent on fluid characterization, especially during the appraisal and development stages. This is when you're trying to determine what have you got, and really you need to be spending the resource to be able to answer this question. Hydrocarbon fluid characterization is the building block of further reservoir characterization, such as determination of resource in place, reservoir modeling, and production forecasting. And not only that, it's also required and an input into production operations and surface processing facilities. Production and facilities engineers also need to know the hydrocarbon fluid properties to be able to design their processing facilities and their pipelines and separators and gathering stations. They need to know the density, the viscosity, the pour point pressure, and all that good stuff. And it's all coming from fluid characterization. This guides the field development strategy to a large extent. For example, the expected recovery factors, the production behavior, any requirement for enhanced oil recovery, or expected fluids handling and processing capability. So, for example, a dry gas will have different requirements compared to a liquids rich gas. Similarly, volatile oil with high GORs will have a different development strategy compared to black oils, which are more on the heavier side. So it guides the development strategy already to a certain extent. If you come to me and you say you have a black oil reservoir with 35 API, then I already have certain things going on in my mind as to what can you expect from the development strategy of this oil or gas reservoir or some of the challenges that you may be facing. Hydrocarbon fluid characterization determines the type of reservoir that has been encountered and its associated PVT or pressure volume temperature properties. All disciplines from subsurface to production operations to commercial require these properties. If you're talking about natural gas, we need to know what type of gas reservoir do we have. We need to know its composition, the volume of inerts. We need to know the gas compressibility factor and its formation volume factor, which goes into the resource in place. And then, very importantly, we need to know whether this is liquids rich or not. Is it going to give any liquids, which is condensate and NGLs? If you're talking about crude oil, we need to know what type of oil reservoir do we have. Is it black? Is it heavy? Is it volatile? What is the oil composition? What is its API gravity? What is oil viscosity? Because it has a huge impact on its flow capability. What is the formation volume factor and the solution gas oil ratio? Because they have big impact on what sort of surface handling facilities do you require. There's numerous examples where you are surface facility constrained, you cannot handle enough gas. Well, if you cannot handle enough gas, you cannot produce enough oil, because unfortunately, oil does come with gas. And the amount of gas that it produces depends on the type of oil do you have. And if you don't have proper fluid characterization, you will not have that answer. So it's really that important, that critical to get this right off the bat. And the time to do the fluid characterization and acquire this data is during the appraisal and the development stage, ideally at the appraisal. If you're already producing, well, it's kind of late because you've already have the surface processing facilities at the surface. And to modify them is an even bigger costly mistake or process rather than putting them in the first place. Types of gas reservoirs. So the first step towards gas reservoir development planning is to determine the type of reservoir that you have. Gas reservoirs are mainly divided into three broad categories: dry gas reservoirs, wet gas reservoirs, and retrograde condensate or liquids-rich gas reservoirs. And really, their classification is based on the amount of liquids or condensate that they produce at the surface. Dry gas reservoirs will not produce any or negligible amount of condensate at the surface, less than 5 barrels per million. This means your surface processing facilities can be quite simple, only there to handle gas and very limited amounts of condensate. In wet gas reservoirs, the condensate ratio will stay constant throughout field producing life. The ratio will be around 5 to 15 barrels per million. And once you get to liquids rich or retrograde condensate gas reservoirs, the development strategy changes. It becomes more complicated. You will be producing a lot more liquids, which is a good thing because condensate sells almost at the same price as oil, but you do need the processing facilities to be able to handle that condensate and its storage and sales and all that, everything that is associated with that. All of this gets determined with the fluid characterization of natural gas reservoirs. As part of the week-long course, we're going to spend an entire day just talking on gas reservoirs development strategy. So we'll go into each of these reservoirs in a lot more detail. The other thing to note in gas reservoirs development planning is the reservoir management of gas reservoirs. So the reservoir management of gas reservoirs depends on the type of drive mechanism that's available. Drive mechanism is the source of energy behind which hydrocarbons are produced to the surface. So gas reservoirs, you can either have depletion drive gas reservoirs, which means that they do not produce any formation water at the surface. This makes them a lot more simpler. You don't need any water handling capacity. You don't need any water disposal capacities. All you need to handle is the gas and potentially some condensate at the surface. If you have water drive gas reservoirs, it makes it more costly and complicated. Uh, you will be producing formation water at the surface along with gas, and so you need some mechanism to be able to handle that water. Again, all of this is part of development strategy. It's part of field appraisal. It's part of development planning. If we are unable to quantify some of these uncertainties, if you're unable to address some of these uncertainties, it can be a big problem towards later on production management of the oil or gas field. Next, I want to spend some time, a couple of slides on oil reservoirs. Oil reservoirs are more complicated than gas reservoirs because they can be classified into more ways. Oil reservoirs are classified according to their density as either volatile oil, black oil, or heavy oil. Volatile oils are much lighter. They produce a lot of gas at the surface. The oil reservoirs are also classified according to their bubble point pressure as either undersaturated or saturated oil. This is a big variable in the development strategy of oil reservoirs, whether they will need any enhanced oil recovery or not. And they're also classified according to the drive mechanism. They can be either depletion drive, gas cap drive, water drive, compaction drive. And really, the development plan or the development strategy needs to have the adequate data acquisition plan to be able to answer some of these questions. What type of oil reservoir do we have? Is it undersaturated? Is it black? Is it going to be water drive? Um, because it will have a big impact on the level of capital investment required, on the development strategy required, and on the surface processing facilities that you require at the surface. How much gas do we expect to produce from this reservoir? Well, can you tell me whether that's volatile or black or heavy? Then I can give you some answer. Do we need any water handling capability or not? Well, is it going to be water drive or not? Because if not, then we may not need such a big water disposal capacity. So all of these questions will need to be answered during the appraisal and development stage to have quote unquote good field development plan. Management of oil reservoirs is more complicated than gas reservoirs because there's just more stuff happening in oil reservoirs. First of all, oil reservoirs will almost always have multi-phase flow of all three phases, oil, gas, and water. They will definitely have two-phase flow of oil and gas. They may have the third phase water also, depending on what drive mechanism do you have. There's just more drive mechanisms in oil reservoirs compared to gas reservoirs, as I'm showing on the right. And then oil reservoirs occur in nature in a wide range, all the way from heavy, which is like 10 API, a lot of heavy oil resource in Canada, in Venezuela, and then all the way to volatile oil, which will be API gravities of 45 and even higher, and a lot of volatile oil reservoirs around the world. Especially in unconventional resources, people are chasing a lot of volatile oil. Similarly, oil reservoirs will also frequently have enhanced oil recovery applied to it. So whether that's water injection or gas recycling, gas injection, that makes the development and the management of oil reservoirs more complicated compared to gas reservoirs. A key point to remember during development planning is that as technical people, we are required to provide production forecast, production scenarios for all three phases, oil, gas, and water, for the life of the field. You cannot have a development plan with no production forecast associated with it. Why would anybody approve that? What is the economics of that if you don't know how much oil, gas, or water you're expected to produce? So we need the full life cycle production forecast for all three phases during appraisal and development stages to be able to develop and install the facilities. And that makes our job a lot more complicated because you're trying to forecast something number of years into the future with limited data. And that's where that's where the uncertainty and that's where the proper data acquisition and proper flow of information across the departments is required so that everybody understands what the unknowns are and what the uncertainties are in development planning. Finally, I want to spend a few minutes on economic analysis and decision modeling before opening up for questions and comments. So why perform economic analysis? The development strategy for an oil or gas field will depend upon its reservoir, fluid, and production characteristics. So we just had a little bit of discussion on that. What type of reservoir do you have? What type of fluid do you have? how much do you expect to recover from it, what will be its properties, and what's the production forecast over the life of the field. And based on that, we can decide what's the best development strategy, whether we need any enhanced oil recovery or not, how many wells do we need any water disposal capacity, how much gas handling do we need, how much liquids handling do we need, um, and where they will be placed at the surface. So that all that has an impact on the type of reservoir do you have. In addition, the surface and commercial considerations such as processing facilities constraints and commodity pricing are also major drivers into field development planning decisions. Depending on which part of the world you are in, your commodity price may be completely different. For example, in North America, we have the Henry Hub for gas, which is currently trading at about $3.50 per MCF. If you are working in Southeast Asia, where you are selling LNG to Japan and Korea, well, that's probably selling at like $10 an MCF. It's a lot more valuable. If you are in the Middle East, and you are working on, let's say, the unconventional gas development, or the North Gas field in Qatar, well, you have long-term contracts to supply LNG to a number of markets in Europe and Asia, and you have your particular LNG pricing. Well, all that is an input to the economic analysis. So I need to understand what sort of commodity pricing am I looking at, and that's a negotiating lever that I may have. Similarly, surface processing facilities constraint. I may have a gas plant available already that has some capacity, and then I can produce my field into that gas plant. So I don't need to spend all the money building a new plant. The management may not approve that. They may say, well, there's a gas plant available. It has 100 million cubic feet per day of capacity. Why don't we look at producing into that gas plant? So then your development strategy needs to consider that you will not be able to produce anything more than 100 million cubic feet per day. And then you will also have to pay processing cost to that other guy who's operating that gas plant. So we need to consider all that into development planning also. The economic analysis allows us to quantify the value of a development strategy and the comparison of the various development strategies with each other. Do I use the existing plant or should I build a new one? Well, if you build a new one, it's more capital investment, but then you may be able to produce at a higher rate. Do I do enhanced oil recovery or should I just produce under depletion drive? Well, if you do enhanced oil recovery, you can produce more oil, but then you need water injectors and water handling capacity and a water source that comes with its own costs. So is it economic to do that? Well, how do I know? How do I know how to compare them until you can show me some economic parameters? Show me the economic parameters of both the cases and then show me the sensitivity so that I can decide which is the best development strategy. This way, the development plan that is the most financially beneficial and value adding for the company can be selected and moved forward with. Management also uses this economic analysis to indicate to the financial community what sort of projects do they have on the books. And they can say, well, this project is expected to add so much so net present value to our portfolio. And the investment community says, yeah, you know what, this looks like a good project. We should buy your stock. That's kind of it works in a very simplistic manner. The most common economic indicators used in the industry to evaluate projects are net present value, rate of return, and payout period. The net present value is the current value of all future cash flows brought back to the current time for a particular development strategy. And it's calculated at a particular discount rate. Most common I've seen is 10%, but that should be coming from your management or your economics group. Rate of return is the return on investment or capital employed for a development strategy so that I can compare if you come up with a project of which has a 6% rate of return. I can say, well, the stock market gives me 7%, so why should I invest in your project, which is only giving me 6%? You need to bring a project that is at least beats the stock market. Um, Companies normally require a development plan to meet a minimum rate of return, and this depends on the company. It depends on the type of company. If you're a government organization, you may have a smaller hurdle. If you're a private equity-backed company, you may require, well, I need at least a 15% rate of return. Otherwise, I can just go and buy NVIDIA stock and make more money. So it just depends on what type of company do you have. And then payout period, how long does it take for me to get my money back? Similarly, if you're private equity, I want my money back in 5 years because I'm private equity. I don't have that much time. But if I'm a government organization, I'm quite okay with a longer term payout because I'm not going anywhere because I'm a government organization. So it just depends on what type of company do you have. As part of our week-long course on development planning, that will be offered in the fall. We will spend an entire day just on economic indicators, and we'll go into a lot more detail into each of these, and also into the discount rates and all that. What are some of the typical cash flows in an oil and gas project? Well, you have the top line revenue, so that's the oil or gas sales. You have capital investments to make. You have wells to drill. They have drilling cost, completions cost, equipment tie cost. You have first surface facilities to build, pipelines, processing plants, gathering stations, and then you have operating costs, or what's called OPEX. You have rental payments to make. You have general and administration, salaries. People don't work for free, so you have to pay them salaries. That's considered G&A. You have utilities, electricity bills, gas bills. Then you have variable costs. You have to maintain the equipment. Equipment fails. You have to lubricate it, maintain it, change parts, pieces. You have processing costs. If you're using somebody else's pipeline, they're not going to do it for free. They will charge you some dollars per barrel or some dollars per MCF of processing cost. You will have chemicals usage. You'll have transportation and trucking. How are you moving your oil? Are you trucking it somewhere? Well, if you're trucking it, the trucking company is going to charge you to take your oil away. All of that is considered operating cost, and all of that needs to be brought into the economic analysis for the particular development strategy that you are looking at. Here's a typical example of a project cash flow. So here I'm showing a gas field which is producing at a plateau rate of about 200 million standard cubic feet per day for about 7 years, and then it starts declining. In year number 0, you can see the level of capital investment required. Remember, you can't produce if you don't have wells, and you can't produce if you don't have surface processing facilities. So all that cost is upfront. So your drilling and pipelines and processing cost comes before you can start to make money. So you got to put in money to make money, sort of thing. So it's extremely important to know how many wells you're drilling and what sort of capital investment is required for surface processing facilities. That's why management keeps a very keen eye on that, as to what's the level of investment required, because they have to come up with that money to develop this field. We're also looking at the sales revenue in dark brown. Then we're looking at the cash flow in orange, and then we're looking at the total operating expense for this field in light blue. And then in dark blue solid, I'm showing the discounted cash flow analysis. So looks like the net present value of this field development after 16 years is about $1.2 billion. And then if we have different development strategies, we can compare this cash flow to the other development strategy and then make the best decision as to what makes the most sense. And that brings me to the summary of today's webinar. So oil and gas field development is a complex task with various uncertainties. These uncertainties exist in all aspects of our business, from the subsurface to surface facilities to commercial considerations. And I hope that in the last 40 minutes, I've given you an idea of what some of these uncertainties are, and how and what are the most important ones we need to focus on. What type of oil or gas reservoir do you have? What sort of recovery factor do you expect? What is the oil in place? What's the size, and what's the size of the price? What will be the associated production forecast? Where are we producing this to? How many wells do you need? Whose surface facilities do we need? How big a plant do you need at the surface? Do you need compression or not? What are the commercial terms? Who's buying this? What sort of price are we getting? Is this LNG or is this dry gas? Is our buyer the government, or is our buyer some other private equity? What sort of oil price do we get? What is the operating expenditure? These are all uncertainties that we need to bring together in a development plan. And all the disciplines need to work together um, to address and quantify some of these uncertainties. So the most economically beneficial plan can be selected and moved forward with. All the various disciplines, they must work in collaboration and open communication with each other. If the surface guys are designing their own facilities without talking to the subsurface, well, you have a clear disconnect. What do you mean we are producing water? You never told us we are producing water. No, we actually told you, but nobody was listening. So that doesn't need, you can't have that, you can't have those costly mistakes. And I don't know how many times I've heard that, well, we have started producing water and we have no water handling capacity. Okay, well, if you don't have any water handling capacity, then we need to shut in wells. That means we can't produce oil or gas. If you can't produce oil and gas, you can't make any money. Nobody is happy. I can promise you. So if those communications haven't happened, or if those uncertainties haven't been highlighted, that's a big problem. And believe me, it's a quite frequently occurring problem in the industry. Some of the most critical tasks in field development planning are fluid characterization, resource and place estimation, reservoir management, economic evaluation, and decision analysis. And again, as part of our week-long full course, we're going to go into each one of them in more detail in the course, and we'll focus on both oil and gas reservoirs and economic analysis in a lot more detail. That brings me to the end of my